Price to earnings. What is it? How do I interpret it? How do I use it? And what are some of the shortfalls of utilizing this particular financial metric? Let's discuss. All right, so the PE multiple, let's break that down a little bit. Essentially, it's a math equation, right? So it's price per share divided by earnings per share. So I want to be able to highlight and discuss a little bit more in depth both components of the ratio, the numerator and the denominator. So in the numerator, it's price per share. Oftentimes, a lot of people have come to me and asked me, okay, I see a stock in my sights. It's $1 per share. One is $5 per share, and I see another one that's $1,000 per share. Now, is the $1,000 one? That's obviously the most expensive one. That's very expensive and pricey, right? Well, no, not really, because price alone is never indicative of the expensiveness or the cheapness of a particular stock or company. What you have to understand is you have to always compare the price relative to the net assets of the business or the net earnings of the business in order to be able to dictate, okay, is this expensive or is this cheap? And that's something that the PE multiple is addressing exactly, right? It's price to earnings. What it's essentially addressing at and getting at is how much are you paying relative to the underlying earnings of the business. Okay, so moving on to the denominator component of the equation is earnings. And what you need to understand about earnings is that it's representative of the net profits of a business during some 4-quarter period. Well, when was that 4-quarter period? That's something that you have to establish and understand in order to be able to compare apples to apples between the PE of one company versus the PE of another company. So the earnings could have been generated over the last fiscal period, or it could have been generated over the last 4 quarters. It could be an estimation or an approximation based on what Wall Street analysts are anticipating for the next 4 quarters or for the next fiscal year. Now, if you're not familiar with what I'm talking about in terms of fiscal period or fiscal year, what you need to understand is that management teams, they can establish their economic calendars to be any 12-month period of time. And it doesn't necessarily have to correspond with the calendar year that most folks like you and I are typically familiar with. So it doesn't have to, so the economic calendar year doesn't necessarily have to correspond with January through December. It can end in October, it can end in March, June, anytime that the manager team deems is necessary for their own needs. The reason why that's going to be so important is because you have to be cognizant of what period of time the earnings were generated. Was it generated during a boom time, a bust time? And that could really swing year to year based on the economic or the industry specific economic cycle. So you have to be cognizant of that. Okay, so what does the PE multiple even mean? How do I interpret it really? I think there are 3 core things you can extrapolate from the PE multiple. First is it dictates whether or not the investment that you're considering, it's expensive or cheap. So if you pay 10 times earnings, that means you paid $10 for each dollar in earnings. Or another scenario, let's say you have a stock that's, again, offered to you for $10 per share and it generates $2 in earnings. That's a PE multiple of 10 divided by 2, which is equivalent to 5 times earnings. So obviously paying $5 per earning or 5 times is cheaper than 10 times earnings. So that's one way, that's one interpretation of what the PE can inform you of. Another thing that the PE can tell you is how long you actually have to wait before you recoup the initial cash outlay of your business. The initial cash outlay for owning that business rather. So what I mean by that is it's a little bit of a theoretical exercise, but if you had paid 5 times earnings, that means, and assuming the company generates $1 in earnings consistently over the next 5 years, that means you'd have to wait 5 years before you get $5 in profit back to recoup the purchase that you had made. Now, the final thing that you can extrapolate from the PE multiple is earnings yield. So again, revisiting the math equation, PE, price per share divided by earnings per share. Now, if you were to just simply invert that, flip it upside down, it's earnings per share divided by price per share. And if just continuing along with the 5 times multiple, if you were to invert 5 times, you would have 1 divided by 5, that's 20%. You have a 20% earnings yield, which is quite a good earnings yield compared to the rate of return off of other financial assets like, say, bonds. And that calculation, the inverted PE, is essentially the same calculation for generating, or rather for arriving at bond yields. All right, so for bond yields, you have annualized coupon payments divided by the price you paid for the bond, and that's your bond yield. And now the reason why that's important to compare and contrast the earnings yield of an equity investment, of a stock investment, compared to the yield of other alternative financial assets, is because these financial assets have different risk-reward characteristics. Traditionally speaking, stocks are considered riskier assets. And because since it is considered a riskier asset relative to, say, bonds, you would want a higher rate of return for assuming that additional risk in stocks than you would in holding a bond. So if bonds were yielding on average 5 to 6%, and you have this alternative equity asset that's yielding a 20% rate of return, that's I think pretty good additional compensation for holding the incremental risk of owning a stock investment. Okay, so moving on, I think when it comes to the PE multiple, though, it does require a certain level of nuance in terms of utilizing that financial metric. So let me just try to illustrate a point really quickly. If you were to consider a company where it's being priced or offered to you for $10 per share, and it generated $2 in earnings over the last 12 months, well, you're getting that. It's being offered to you for 5 times PE multiple on a historical earnings basis, right? Okay, like we just said before in the prior analogy, this looks like a good earnings yield. It's a good rate of return. But if you were to dig in a little deeper and do a little additional research, you find that the management team is anticipating earnings of 10 cents over the next fiscal period. So forward looking now, you're going to generate, the company is going to generate 10 cents. So if the price that was offered to you was $10 per share, generated $2 in profit over the previous 12 months, and now over the next 12 months, the management team is anticipating 10 cents in earnings due to whatever factors, right? You have margin compression, you have competitive dynamics that are disrupting their business, et cetera, et cetera, et cetera. So that's why you have an expectation of 10 cents in earnings. What is the new forward? What is the more effective or useful PE metric to go by? Well, the forward-looking PE multiple, because now you're looking at a PE multiple of 100 times forward earnings. And probably the reason why historical earnings are trading at 5 times earnings is because the stock market, or all the participants in the markets, in anticipation of this decline in earnings, probably sold that stock. And consequently, because of the market selling off, the shares went down so dramatically to an extent that historical earnings, the stock looks cheap on a historical earnings basis. And now on a forward-looking basis, though, it's very expensive, right? Because it's going to only generate 10 cents in earnings. So you have to integrate, forward and backwards looking data in order to interpret, okay, what's going on with the PE multiple. And so I'm kind of stealing Warren Buffett's analogy here. He said, and I'm kind of paraphrasing what he said, but just like in life, you never want to steer through life or through investments through the rear view mirror. You can't look at historical numbers alone in order to make rational investment decisions. And so the PE multiple, based on which earnings period you're looking at, it's going to have an enormous influence on the expensiveness or the cheapness of that particular stock. Okay, so one critical shortfall of the PE multiple is that it oversimplifies the complexities around 2 alternative investments. And what I mean by that is, let's just create an illustration real quick. You have 2 companies, company A and company B. Let's assume that company A doesn't have any debt whatsoever. Now, it trades at $10 per share. It's going to generate $1 in earnings over the next fiscal period, and effectively trades at 10 times PE multiples. So now consider company B. Company B has $1,000 in debt, yet the price per share is $10. It's anticipated to generate $1 in earnings and is trading at, therefore, effectively 10 times earnings. It's a 10 times PE stock. You have two companies trading at the same PE multiples, but the risk characteristics of both companies are totally dramatically different because company B has $1,000 in debt. Now, the PE multiple doesn't consider this kind of dynamic. And so it's going to, like I said, oversimplify some of the realities between alternative investment opportunities. So if you enjoyed this episode and you thought that this conversation around the PE metric was in fact useful to you, I'd really appreciate it if you hit the subscribe button, give us a like, and let your friends know who are interested in investing that this resource is available and out there for you guys to use. And so just another plug, I just want to let you know that we have a podcast available for you guys whenever you can't access YouTube or whatnot. We have episodes. The content is relatively the same, and it's out there for you guys to utilize as well. So check that out, and I'll see you guys in the next episode.